Quick legal disclaimer as always. This is for educational purposes only. It is not financial advice. Every investment carries risk, including the risk of loss. Okay, let's get right into it. The entire passive investing story that's been spoon-fed to retail traders for the last decade, it's about to slam into a mathematical wall. And no, we are not talking about some garden variety correction. We're talking about a potential structural failure in the S&P 500 itself, and it's got a date stamped on it, 2026. This isn't just some theory. It's an arbitrage that we're seeing institutional capital execute right now in the shadows, in the dark pools.
All right, let's go. Hit the like button, subscribe to the channel, and comment your top ticker right now. Retail thinks passive index funds are safe, but Wall Street knows the 2026 corporate debt wall is about to blow up the S&P 500. Trillions in debt cannot be refinanced, and institutions are violently shorting zombie companies. Today, we expose how to escape the index trap and rotate into idiosyncratic physical monopolies. So what are we really talking about here? That 401k, that IRA, the one packed with all those safe index funds you've been told to just buy and hold forever? Well, it's holding a lot of companies that, from a purely quantitative view, are basically insolvent. The only reason they're still around is because of a decade of 0% interest rates. Well, that party is over. The bill is coming due, and believe me, the big money is already heading for the exits. Now you might be thinking, where's the proof? And the fascinating part is, it's not buried in some 1,000-page report. No, it's hiding in plain sight, right in the order flow if you know how to read it. So we're going to follow the money. And let me tell you, it paints an absolutely brutal picture of a massive rotation out of systemic risk and into hard, physical, monopolistic assets. Okay, you need to look at your screen right now because this one slide tells the entire story. On the left, we've got HYG. Think of it as a basket of high-yield, high-risk, zombie corporate debt. See that massive block of selling? That's our system mapping huge institutional distribution, selling that's happening off the public exchanges. Look at the technicals. It's weak, constantly getting slammed down at the VWAP, the volume-weighted average price. Now, look at the right. This is Vistra, VST. It is the literal polar opposite. This is a debt-free utility that's powering AI data centers. See that? That's heavy institutional accumulation. The price is being held above its VWAP, which shows incredible demand. This is not a coincidence, people. This is a calculated, targeted rotation from paper debt to physical assets.
So let's just translate all that chart jargon into plain English. Here's what's happening. Wall Street's algorithms can see that a significant chunk of the companies inside your S&P 500 index fund are, for all intents and purposes, bankrupt. They are using the endless river of retail buy-the-dip money as their personal exit liquidity. As they sell you their shares, they're taking that cash and plowing it into the physical AI grid, into companies like nuclear utilities that couldn't care less about the corporate bond market.
Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits.
Okay, so we've seen the what, we see the money moving, but now we get to the most important question, why? Why is this rotation happening with such incredible urgency? Because what we're seeing on the charts, that's just the effect. The cause is a concrete, non-negotiable macroeconomic event barreling toward us, and it's now less than 2 years away.
This is the number that changes absolutely everything. $2.5 trillion. That's the mountain of corporate debt issued when money was basically free that has to be refinanced by 2026. But it has to be refinanced at today's catastrophically higher rates. For a huge number of these companies, it is mathematically impossible. Their business models literally do not work if they have to pay 5, 6, or 7% on their debt.
Let's make this real. Here's the poster child for this whole disaster, Carvana. To stay out of bankruptcy in 2023, they cut a deal. They got a pick-to-cash holiday, which is just a fancy way of saying they got a hall pass. They didn't have to pay their interest in cash, they just tacked it onto their total debt. But that hall pass expires in mid-2026, and at that exact moment, the company is suddenly on the hook for over $500 million in new annual cash interest payments. That is the ticking time bomb sitting inside so many index funds. And believe me, this is not a secret on Wall Street. The smart money is already pricing this in. This chart from the German central bank shows the cost of buying credit default swaps, which is basically just insurance against a company defaulting on its debt. Just look at that insane spike during the 2008 crisis. That is the market pricing in a full-blown domino effect. While institutions are buying this exact kind of insurance right now, getting ready for a massive wave of defaults from these zombie companies.
So if institutions are systematically buying insurance against corporate debt and running away from the companies that are addicted to it, where is all that capital flowing?
It's not just sitting in cash, I can promise you that. No, it is making a violent rotation into an entirely new asset class that is completely walled off from this coming debt crisis.
It is flowing right here, into the physical guts of the AI revolution. We are talking about the power grids, the data centers, the fiber optic cables. This is a $7 trillion infrastructure build-out over the next decade. And the key part? The companies doing this work are not the debt-drowned zombies in the S&P 500. They are cash-rich, physical monopolies.
Let's circle back to our proxy, Vistra. This profile is the anti-Carvana. It's the perfect example of an anti-zombie company. First, investment-grade credit. That means it can borrow money cheaply whenever it wants. It's printing almost $3.6 billion in free cash flow. It has a near monopoly on nuclear power, which is the only reliable 24/7 carbon-free energy that AI data centers demand. And it's already locking in huge 20-year contracts with giants like Meta. This is what an institutional safe harbor looks like.
Okay, so we've got the thesis, we've identified the players. How does this actually play out from here? Let's map out the most likely scenarios and, far more importantly, the risk protocol you need to navigate them. Because let's be honest, a thesis without a rock-solid execution plan is just an opinion.
As we see it, there are three main paths forward. First, the bull scenario. This is our base case. The zombie defaults start, fear spreads through the debt market, and capital flees the big indexes. This becomes pure rocket fuel for the AI infrastructure plays like VST. Second, the bear case. What could derail this? The Fed. If they panic and turn on the money printers again, another round of QE to bail out corporations, you could get a broad, liquidity-driven melt-up that delays our thesis. And finally, the black swan. This is when the corporate debt problem gets so big and infects the sovereign debt market. That's a systemic reset where everything, even the safe havens, crashes hard and fast.
All right, pay attention, because this is the most critical slide in the entire presentation. These are the rules for capital defense. They are mandatory, non-negotiable. 1. Deploy OTO brackets. That's one triggers the other. It means your entry, your take profit, and your stop loss are all placed at the exact same time. It removes emotion and enforces discipline. 2. Use a trailing stop based on 2.5 times the average true range. This adapts to volatility, so it gives a trade room to work while still protecting your downside. And 3. This is a hard rule. You do not touch any asset trading below its 200-day moving average unless you have a defined hedge in place. This filter alone will keep you out of so much trouble.
If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on the debt wall and the tickers mentioned, HYG, VST. I really want to know what you think. Is this on your radar? Let me know. As always, trade smart.